Hello friends, today we need to talk about something that looks like great news on the surface, but carries a much darker and more complicated reality underneath, because UK house prices are suddenly being tipped to surge again, and many people are celebrating without fully understanding what is really driving this move or how fragile it actually is. Right now, the headlines are screaming optimism. Mortgage rates are falling faster than almost anyone predicted just a few months ago. The average 2-year fixed mortgage rate has dropped below 4% for the first time since early 2023, and 5-year fixes are even cheaper, hovering around 3.7%. Some lenders are going even further, quietly offering deals as low as 3.5% for buyers with large deposits. Compared to the chaos of 2022, when mortgage rates shot past 6% almost overnight after the mini-budget and threw the entire housing market into turmoil, this feels like a complete reversal of fortune. Banks that were once pulling products and slamming the brakes are now locked in a fierce price war, desperate to attract customers. For millions of people who were completely priced out of the market just a year ago, borrowing suddenly feels affordable again, and that change alone is enough to reignite powerful emotions around property. That emotional shift is already translating into real activity. Buyer demand is heating up quickly. Major property portals are reporting a sharp jump in inquiries compared to this time last year, and estate agents across the country are saying viewings are up, sometimes dramatically. In popular areas, homes are attracting multiple offers within days of being listed, and in some cases sealed bids are quietly making a comeback, something we have not seen consistently since the pandemic boom years. First-time buyers who had all but given up hope are suddenly back with calculators in hand, rerunning their numbers and realizing that monthly payments might finally be within reach. The sense of momentum is building fast, and the big forecasting names are responding. From Savills to Knight Frank, predictions are being revised upwards, with some now expecting house prices to rise by as much as 4% this year alone. On the surface, it all sounds like the start of another property boom. But this is where the story takes a much more unsettling turn, because this surge is not being driven by a strong economy, rising productivity, or meaningful wage growth. It is not even being driven by population growth. It is being driven almost entirely by one assumption, and that assumption is that the Bank of England will keep cutting interest rates throughout 2025. Financial markets are currently pricing in at least 3 more rate cuts this year, which would bring the base rate down to around 3.25% by December. Buyers, lenders, developers, and analysts are all behaving as if these cuts are already guaranteed. The entire rally is built on this belief, and that is what makes it so dangerous. The problem is that the Bank of England itself is starting to sound far less confident than the market. Inflation has not behaved the way policymakers hoped. Instead of continuing its steady decline, it has proven stubborn, even creeping back up in recent months. Core inflation, which strips out volatile items like energy and food and is closely watched by the bank, is still sitting at around 3.2%, well above the 2% target. Wage growth remains elevated at roughly 5%, and that is feeding directly into service sector inflation, which is notoriously difficult to bring under control. Several members of the Monetary Policy Committee have recently given speeches warning that cutting rates too quickly could reignite inflationary pressures and undo the painful progress of the last 2 years. While markets are betting on a dovish pivot, the tone from the bank is increasingly cautious. At the same time, government policy is making the Bank of England's job even harder. The latest budget included major spending increases, including higher public sector wages and large-scale infrastructure investment. While these measures may support growth over the long term, they also inject more money into an economy that is already running hotter than expected. Employer national insurance contributions are rising, and many businesses have been clear that these extra costs will be passed on to consumers through higher prices. The Office for Budget Responsibility has warned that these policies could add around 0.5 percentage point to inflation over the next couple of years. This creates a direct conflict between fiscal and monetary policy. If the government is stimulating the economy through spending, the central bank has far less room to stimulate it through rate cuts without risking a return to high inflation. The global backdrop only adds to the uncertainty. With Donald Trump back in the White House and announcing sweeping tariffs on imports from China and the European Union, global trade tensions are rising again. These tariffs are likely to push up costs for goods worldwide, and the UK will not be insulated from that. If inflation starts to pick up internationally, central banks everywhere will think twice before cutting rates aggressively. The US Federal Reserve has already signaled it is in no rush to cut further, and the European Central Bank has adopted a more cautious stance than markets expected. If the Bank of England were to cut rates significantly while other major central banks hold steady, the pound could weaken sharply, making imports more expensive and adding yet more inflationary pressure at home. It is a delicate balancing act, and the risks are stacking up. So what happens if the Bank of England does not deliver the rate cuts everyone is expecting? Or worse, what if it has to pause or even reverse course? The impact on the property market would be immediate and brutal. Mortgage rates would rise sharply, potentially even higher than in 2022 as markets panic about the inflation outlook. Buyers who have stretched themselves based on today's rates would suddenly find deals unaffordable, and many would pull out of transactions altogether. The surge in demand we are seeing now would evaporate almost overnight. Sellers would be forced to cut asking prices to attract a much smaller pool of buyers, and prices would stall or start to fall. Anyone who bought at the top expecting quick gains could find themselves in negative equity. This is not theoretical. We have seen this exact pattern before. In 2022, the market was riding high on cheap pandemic-era mortgages until rates spiked and confidence collapsed within weeks. Transaction volumes fell by nearly 30% year-on-year, and house prices declined for several consecutive months, wiping out a significant chunk of the boom. Thousands of buyers walked away from purchases, and sellers who needed to move had no choice but to accept much lower offers. The difference now is that the market is even more sensitive to rate changes because prices are so much higher relative to incomes. In many parts of the country, the average home costs nearly 9 times the average salary. That means even small changes in borrowing costs have an outsized impact on affordability. Estate agents are already noticing worrying signs beneath the surface. Sellers are pricing homes as if rate cuts are guaranteed, while buyers are becoming more cautious, sensing that something does not quite add up. The gap between asking prices and achieved sale prices is widening in some areas, and properties are sitting on the market longer than expected despite all the talk of booming demand. Some buyers are getting cold feet after running worst-case scenarios and realizing that if rates do not fall as predicted, monthly payments could become unmanageable. Others are deliberately waiting, hoping that if the Bank of England disappoints, prices will soften and better deals will emerge. This standoff is making the market increasingly fragile. Supply-side risks are also being overlooked. House builders have ramped up construction based on expectations of strong demand, but if that demand fades, they could be left with unsold stock and rising debt. Several major developers have already warned that higher costs and planning delays are squeezing margins. If sales slow, some could face serious financial strain. A wave of distressed sales from developers needing to offload inventory would flood the market with new supply just as demand weakens, pushing prices down further. This is exactly what happened during the financial crisis, when several big builders came close to collapse. Buy-to-let landlords are under pressure too. Higher stamp duty surcharges, increased capital gains tax, stricter energy efficiency rules, and the removal of mortgage interest relief have all eroded profitability. For anyone involved in the market right now, the message is clear. This is not a time for blind optimism. Buyers should avoid stretching to the absolute limit and build in buffers for uncertainty. Sellers need to be realistic, because a home that sits unsold in a shifting market only becomes harder to move. Renters should not rush into buying out of fear, because the promised surge may never fully arrive. The UK housing market has always been cyclical, but right now it feels like we are perched at the top of a climb, unsure whether the track ahead is smooth or whether a sharp drop is coming. If you found this breakdown useful and want to stay ahead of what is really happening in the UK property market, make sure you like this video and subscribe so you